Good afternoon, everyone. My name is Michael Naidrich, and I am the co-CEO of AmeriVet Securities. And we are joined by our special guest, who we've had on several times before. Priya, we welcome you back. Thanks for coming on.
Thanks for having
And
me.
of course, thank you. And also, we have my partner, everything all Fed, rates, liquidity, CFA, Gregory Faranello. Gregory, hope you had a good weekend, bud.
How are you, Michael?
Good. I thank you both. I'm really excited about this. Shift my focus away from college football back to the real world and feds and rates. And look, this is I know I'm guilty. I say it every time. This is a big meeting, but I do think this is again a really big meeting. And I think everyone's thinking a quarter a point, and maybe an outside shot at 50, but I think everyone's sort of circled around 25. But I think, as I always say, really the devil is in what they're saying afterwards and where it's headed. So, I'm smart enough to know that I should leave it to people who are much smarter than me. So, Gregory, I'll kick it to you and Priya, and maybe I'll jump in later in the talk. Thanks, guys, both of you.
Sounds good. Thank you, Michael. Priya, thank you so much for coming on. Let's dive right in. I mean, what do you expect for this week? It is a big meeting. What are your thoughts for the meeting in general?
So I think we get the 25 cut. I think it was sort of hinted at by Chair Powell at Jackson Hole. So I think the market set up for it. The economic data actually coming into this meeting would also support the idea that the Fed can continue to normalize. Remember, they cut last year 100 basis points. They've been on hold for the last 9 months, and they could restart. I do think we're not going to get a lot in terms of big messages going forward because Chair Powell is likely to reiterate data dependence. And I do think we're at an interesting point. I mean, you have to be careful for what you wish for. I was kind of hoping that we got some slowing in the labor market to allow the Fed to start to cut. I was hoping we didn't get the big CPI increases. That was the concern after tariffs. And we got neither, but the slowing in the labor market in the last couple of months has been a little more than what I think we could justify through just a normal soft landing. So I think that gives me a little bit of concern. I don't think the Chair Powell's likely to signal that this is that worrying. I think he's going to highlight what actually Governor Waller has called in his previous speeches good news rate cuts. And I think that's why the markets come into this potential cut by the Fed in a good mood. Because if things are slowing and the Fed is able to cut just the right amount as quickly as they can to get policy into neutral territory, maybe they can prevent things from weakening. I think that's the hope that the market has in there. And I think the Fed delivers, but doesn't talk about cutting below neutral. I do think we're going to get the dot plot and we're going to get one more year. So we're going to get their estimates for 2028. Now that's far off enough. Policy could be very different. We've had a lot of policy shocks this year. But I think their baseline is likely to be getting in a gradual way, the Fed cutting close to 3%, which is the Fed's estimate of neutral. So this idea that they're starting the process, there's no rush, but they can just gradually cut to neutral and keep, the soft landing going, which means growth in the 1 to 2% range. Inflation a little bit above target, but getting close to that 2% level. I think that's the message we're going to get. I'm going to be watching the reaction function, though. Like if Chair Powell, I hope, is asked about how high does the unemployment rate have to go before they get nervous and want to go into accommodative territory, or how much can they tolerate in terms of inflation? I think if they have the nightmare scenario of the unemployment rate at 4.5 and inflation picking up, which one do they? And he's going to try and give non-answers as he often does. But just to read between the lines, I think the reaction function could be interesting. I don't think you're going to see much in terms of their outlook being very different. I think they're going to say, look, we're just going to respond based on the incoming data, but start the process, signal that the process towards getting to neutral is underway.
So that, yeah, it's interesting, right? I guess if you look at the forward SOFR curve out to 2026, we're kind of at the longer run neutral rate for the Fed. What do you see for the Fed going forward from this meeting on, assuming we get 25? What gets them moving a little bit more quickly here, do you think?
Sure. So this is where I'm going to get into my outlook. And again, this is not JP Morgan Investment Bank or asset management. This is sort of my view here. Um, I think our base case is we stay in the soft landing. So even though you won't hear the Fed necessarily tell us exactly how quickly they'll cut, we expect 25 basis points until they get, maybe the next 2 or 3 meetings that they cut in the cadence of 25 basis points a meeting. And then once they get close to 3.5 or 3.25, they can maybe slow it down and cut every other meeting and get close to 3%, which is actually very close to what is priced in. Now, the second part of your question, what gets them to go faster? I think if the rise in the unemployment rate is, and I shouldn't just say the unemployment rate, also payroll numbers. We know that there's a supply issue with the labor market, or there's a supply component to the decline in payrolls because of immigration. If payroll numbers were coming in at 50,000 or 75,000, I would say that's in line with with break-even payrolls. If we get the numbers we're getting now, 25, 30,000 average, that's a lower than the break-even rate. If you continue to see that or decelerate further, or the unemployment rate get, I think, above 4.5, these are levels where I think the Fed will want to cut faster and signal that they can go below neutral, because they'll want to go into accommodative territory. If we're at risk of slipping into, recession or even close to zero on GDP, or the unemployment rate starting to really pick up, I think the concern is in recessions, you often see a non-linear increase in the unemployment rate. It's been 2 months of weak numbers, though if I look at the revisions, it's actually closer to 4 months, because you had the 3-month revisions plus last month. But it's still in the realm of it's slowing. It's a little uncomfortable in terms of the pace of slowing. But if that accelerates, I think this Fed has been clear. Chair Powell's been clear before that they will react if the data forces them to. And at that point, I think they can go in. And we've seen the Powell-led Fed wasn't shy when they cut 50 last year, or they hiked 75 when they felt that they were behind the curve. And so even though I'm looking for the 25 this week, if you do see the next payroll report or the one after that starting to worsen more materially, I think they can cut in 50 increments. And then that dot plot can actually suggest going below 3%, which means that they will be in accommodative territory. So there is a case where they can be a lot more aggressive, but the data is not there yet.
Yeah, no, that's a great point. I mean, the chairman is certainly not afraid in both directions to move rates. I mean, he's certainly proven that. So I think that's a fantastic point. One of the things that one of the narratives out there, which and I think it comes up with our clients too, is this notion of what happened to the long end of the curve the last time the Fed came down and normalized 100 basis points in 2024. So I'm going to tie that into what do you think about, and we're seeing a rally today in the market in the 10-year. The administration is certainly focused on the 10-year part of the curve. Do you think this potential rate cutting cycle is synonymous to what we saw last time? And then, what's your view based on that with regard to yield curve and then maybe risk assets and credit product?
Sure. So a lot in there. Let me quickly breeze through it all. So it is tempting to compare this year to last year, right? We had the slowing in the labor market last summer. The Fed cut 50. I mean, if they had all the data, they might even have cut in July. They didn't cut, so they went a little more aggressive. And then the rates backed to the 10-year backed up, to your point, 100 basis points. I actually think it's very different this time round, with a big caveat that if the data turns around, so the next few months, if I go back a year, the October payroll report, November payroll report came in actually much stronger than what the run rate had been. That happens again this time. I think rates can absolutely rise, but I also think the Fed is not going to continue to cut, because I think the reason they continued to cut last year was they thought rates were very restrictive and there was no concern around inflation. This time round, there's a big debate. Is neutral 3, 3.5? And as the Fed starts to cut, they get closer to neutral. Plus, the gorilla in the room, the 800-pound one, is still inflation. We're dealing with a high effective tariff rate. So far, it hasn't shown up in inflation. Maybe it will going forward. I think that's the risk, and a lot of Fed officials have brought that up. So I do think if the data turns out to improve, and what I was just talking about, this non-linear slowing, maybe it's just a quirk, seasonal quirk, And actually the data just turns out you get 100,000. And I would say we don't need 200, 300,000 payrolls. I think even 175,000 on payrolls in the next few months is going to be a lot more comforting. I don't think they continue to cut. I think the Fed will stop. They could cut once or twice and then that's it. So I think that prevents the long end from selling off. You won't get that idea that the Fed might be overly dovish. I mean, the other thing with last year was the elections. I mean, we had the build up towards the election, this idea that you'll have certainty one way or the other. I think as President Trump's approval rating, or at least in a lot of the predicted markets, was increasing, this idea of pro-growth, higher deficit views began to get priced into the Treasury market. It was one of the reasons why rates rose. You just don't have that this time around. In fact, I think the deficit is better today than it was a year ago. And every time I say it, people cringe because they say, oh, you sound like the deficit doesn't matter. No, I think we have a long-term deficit issue. But on a marginal basis, tariffs are raising 300, 400 billion in revenues per year. That's better for the deficit. It's kind of paying for the one big beautiful bill over a 10-year period. If tariffs, I know it's a big if, but if tariffs stay at this level, it'll pay for the extension of the 2017 tax cuts. So I don't see rates rising. And then finally, the point you made, this administration cares about the tenure. I mean, whether it's Secretary Besson, whether it's President Trump. And so when we talk about, maybe the tenure, I think the tenure might be the adult in the room or the policing mechanism, where if the Fed looks like they're being political, which I actually don't think they are. I think there's true division at the Fed in terms of where's the labor market, what's the inflation risk. But let's say there was a risk of Fed losing credibility or the deficit getting out of control. I think the long end would rise to the point where policy would be corrected. And we saw that after Liberation Day. I still think that the tenure is very powerful. And so, do we cross? I think our view for the 10-year, now coming back to our view for markets, I think 375 to 4.25 is sort of our range in a soft landing. Now, if the unemployment rate suddenly starts to rise a lot more, I'll give you a lower bound that's going to be less than 375, but I think we stay in that range. Can we get as high as 450 if the economy turns out to be okay? Maybe that's the upper bound. I don't see us rising much more than that. So that's sort of the rate range. On the curve, it's steepened a lot because we've priced in a Fed cutting to neutral. We've also priced in this risk of, maybe sell America or US exceptionalism, little less than it was before. I think it's well priced in. So we're actually neutral on the curve. If you gave me a crystal ball and told me that there was a recession, I'd love the steepener. If not, I don't think the steepener is already priced for all the rate cuts. So we're neutral on the curve. You had such a view at this point on the curve. To have a steepener on, you have to have a view that we're headed into a recession. And that's our tail risk. That is not our base case. And then finally on spreads, we like high quality spread product. I think you look at corporate America, despite the shocks we've had to deal with, tariffs, immigration, a lot of other supply chain questions coming up. And yet corporate America, solid. We came into the year with strong balance sheets. Earnings have been good. So I think owning credit of these high, as we call them, high quality spread product, investment grade or high quality high yield. So double B, even some single B high yield companies we think look attractive. Those spreads are tight. But the companies are doing the right thing. They're not re-levering up. And so, earning that carry, owning some duration as a hedge in case things slow down, that's how we sort of positioned our multi-asset bond portfolio here.
Yeah, that makes sense. I mean, spreads look tight, but as you and I know, over time, spreads can stay tight for a long period of time if the economy holds in. I want to talk, and Mike may chime in at some point here too, I think, and Fed independence. We talk about, I'm a believer in Fed independence. I've actually been an advocate of Fed Governor Waller to potentially be the next Fed chair because I think he understands the institution of the Fed. And, I think it's a pretty diverse job. With regard to Fed independence, we know there are changes coming here. Do you think we're priced for Fed independence? And kind of what do you see going forward here, potentially?
So there's a lot of hand wringing on Fed independence. And yes, let me start by saying we should all believe in Fed independence. I mean, I think it's one of the reasons why the US has been exceptional and other countries. I think you need to have a credible, independent central bank that has a clear mandate. Um, the question I often get from clients is it, I guess you asked, is it priced in? I think the market's giving the benefit of doubt to the Fed and I would say even the administration not to compromise that credibility too much. I mean, should we have a debate about Fed governance or how should the Fed think about when there's a conflict, etc.? Sure, I think debate is good. But for example, and I'm with you. I think if Governor Waller is picked as Fed chair, I think he's a very credible candidate. He has not always been in line with the chair, but that's what you want. That's why we have a committee. So I actually think the institutional guardrails of the Fed are very strong. I mean, the Supreme Court has ruled that the Fed is a so-called special institution. The chair cannot be fired by the president. I think this is all something that protects independence. Should there be debate? I think who the next Fed chairs will be important, but Chair Powell is in charge until May of next year. He might even stay on the board. His board seat is still around. And so I think the market is not really pricing in a loss of independence. And I would say rightly so. I mean, I haven't seen, is it concerning? We haven't seen attacks on the Fed in this form before. But, if we're debating who should be at the Fed and what should the governance do, I think debate is fine. Have it, make it transparent. I think the framework review that the Fed just did over a 5-year, the 5-year framework review, actually, that's very helpful in establishing that credibility because they just said that they are not going to overshoot. And I think that would be a concern. If I thought that the Fed was not independent, they might be tempted to overshoot. Let the economy run hot, let inflation get out of control. They've just told us that collectively they have decided to adopt this framework review about a symmetric target on inflation and the unemployment rate. That's a good sign that I think helps credibility. So I know the interview process is ongoing. I'm hopeful. I mean, whether it's Governor Waller or frankly, most of the other names that I see are credible Fed officials. But ultimately, it is going to be a committee. It's not, it's a, the chair is an important voice, but it's not the only voice. And so I think there's concern, will the presidents be ratified? It's a concern, but I really don't see how, and even if the president has appointed somebody at the board, they're not the president's puppet. And I think the institution protects them. So, I think we should all reiterate. In fact, I was heartened by the congressional hearing with Steve Myron, where both sides of the aisle talked about independence and credibility. He reaffirmed that he has no plans of reducing that. And I think just tells you there's a lot of focus on it. The bond market is also focused on it. So if not for anything else, I think the bond market will let its displeasure be felt if it feels that there is some lack, or maybe I'm giving the bond market too much credit, but I do think the market will say, no, not so fast. And that might constrain any attempts in affecting independence. So it's a concern, makes for if you can't sleep well at night, you can think about that and stress. But, we're not positioning any portfolios on it. We're not positioned for it because I think people understand how important it's like a basic tenet of how capital markets are run in the US. So I don't think they'll really tamper with it.
Yeah, just watch the 10-year, right? The 10-year is telling you right now that, to all your points, which I think are valid, is telling you that, the market is in pretty good shape here in general with regard to, overall Fed independence. And I think where we go, Michael, jump in.
Yeah, a couple of things. First of all, thank you both. It's a very enlightening conversation and a very important one. I think that I am grateful for Secretary Bessent because I think he's always the adult in the room. And, I think he keeps all those things that Priya is talking about in check, whether it's independence or some of the other things. I think he has a very good perspective that keeps the president on path, maybe when he might want to get off path. So I think we saw that a little bit during Liberation, and he got the markets back open pretty quickly. And I think it's been if you look at the deals and how many are coming and how many times they're oversubscribed, and I mean, I think last week was 50 billion. This week will be 45 billion. They're calling for 155 billion in September, and that's a pretty wide open marketplace. So I just want to thank you both. I know that you're both very busy. Priya, thank you to you and the JP Morgan team for your time, and grateful for that partnership we have with JP Morgan as well as yourself. So I thank you both. I look forward to hearing both of your comments and reading guys and gals put out afterwards. So thank you to every one of our clients. And if you'd like to speak to Greg, he is available by phone, Zoom, or plane. So have a good day, everyone.
Thank you.